Okay, great. So as I said, I represent Multibank Group. I'm a product specialist. I've been with the company for a while now. I'd like to give you a brief intro on Multibank Group, tell you a bit about us, who we are and our position within the market, and then I'll go into a bit more of a detailed presentation on the changing landscape of Forex regulation. So Multibank Group was established in 2005 in California, USA. Since the company's launch, it has evolved into one of the largest online financial derivatives providers worldwide, with a current paid-up capital in excess of 320 million. We maintain 25 offices globally across 5 continents and 7 regulations, including ASIC, DFSA, and FSC brokerages licenses, and BaFin, FMA, CNMV, and CIMA asset management licenses. We service an extensive client base in excess of 280,000 clients and partners from around 90 countries worldwide. So we offer in excess of 1,000 tradable instruments, and Q1 to Q3 2020, our total turnover between Q1 and Q3 exceeded $2 trillion. We work with A-rated custodians, where we maintain segregated client accounts and a paid-up capital in excess of 320 million. So we received an investment-grade rating from ARC Ratings in London in 2019 to further cement our position as a global leader and secure counterparty for our clients and partners. Since inception, we've received over 40 awards in recognition of our services to the trading community, including Best FX Service Provider 2020, Best FX Trading Platform MENA 2020 from various different award providers. We offer attractive trading conditions, including spreads from 0 and up to 1 to 500 leverage, and competitive partnership packages for IBs and affiliates. So come and visit us at booth 26. You can meet one of my colleagues and our representatives, and they can discuss your needs in a bit more detail. So as I mentioned, I'd like to go into the changing landscape of Forex regulation and the impacts on you as a trader. So in 2018, ESMA, the European Securities and Markets Authority, introduced legislation on maximum leverage guidelines. This encompassed all European regulatory bodies, including FCA and CySEC, and reduced maximum leverage from 1 to 500 to 1 to 30. If we look back to the subprime mortgage crisis of 2008 and the subsequent introduction of the Dodd-Frank Act, we saw the US regulator tightening trading conditions with a maximum of 1 to 20 leverage, no hedging, and laws restricting international brokers from opening accounts for US clients. It seems that the adage of the US sneezes and the rest of the world catches a cold rings true. The reasoning behind the leverage restrictions is questionable. I'm of the opinion that the regulator does not fully understand the market, as they reference a percentage of losing clients as a focal point. When comparing traditional stockbrokering back in the 70s and 80s, before CFDs, we would have approximately the same percentage of losing clients. So one thing's for sure is that by taking these measures, the regulator reduced the number of complaints, which is a great success, whilst losing considerable revenue to overseas brokerages, which in my opinion is a failure. We saw an influx of business heading to Australia and ASIC-based brokers, where traders could still get 1 to 500 leverage. Traders wanted the conditions that were outlawed in Europe, and they were willing to go offshore to achieve them. Fast forward 2 years, ASIC are now following suit from the ESMA legislation. Now, this is probably due to the pressure implemented by its regulatory peers. As of the 29th of March 2021, leverage restrictions will be placed on all CFD trading, with maximum leverage ranging between 1 to 20 and 1 to 30, depending on the asset. Now, this is undoubtedly going to be a major blow for the Australian trading community. A panel of the larger, more respected Australian brokers came together to contest the ruling to no avail, and so the changes in regulation stand. So let's look a bit deeper. What's the benefit of leverage? Does leverage increase risk of trading explicitly? There's no doubt it can do. And without understanding how to manage leverage, clients can be chewed up and spat out of every trade. For example, I open an account with Multibank Group with $10,000. Multibank Group offers me 1 to 500 leverage. And so I take a position of 5 million. which is 10,000 times 500. So we have the lot size multiplied by the leverage multiplied by the account balance. The market moves against me 0.2%, which is 10K on a 5 million trade, and I'm wiped out. I lose my 10K. I'm out of the market and I'm crying into my coffee, questioning why it always happens to me. I'm faced with the fact that I'm a fool, and a fool and his money are easily parted. Now, this is not how to trade with leverage. So let's look at another scenario. I open an account with Multibank Group and qualify for the 1 to 500 leverage with $10,000. I open another account at an onshore brokerage with $10,000. The onshore brokerage offers me 1 to 30 leverage, whilst I'm getting 1 to 500 leverage with Multibank Group. I place a standard lot with each broker, so a standard lot of 100,000. At Multibank, that standard lot cost me $200 margin, whilst at the onshore broker, the same trade cost me $3,333 margin. So that's a huge difference of $2,133 for the cost of one standard lot. So it's very simple. You can work out the margin cost with a simple formula of lot size divided by leverage. So here we can see the benefit of trading with leverage as a tool to reduce margin cost. So for sure, leverage is a double-edged sword, but when used responsibly, it's a valuable trading tool. We can assume the leverage used correctly is a desirable trading tool for traders, unless you meet two of the three following parameters. You can't have more than 1 to 30 leverage in an onshore jurisdiction. So you need to have the size of your financial instrument portfolio, including cash deposits and financial instruments, exceeds 500,000 euros. You've performed large transactions on the relevant market with an average frequency of 10 per quarter over the previous 4 quarters. Or you've been working in the financial sector for at least 1 year in a professional capacity. So what are your options if you don't meet that criteria? 1 is 1 to 30 leverage, which means an increased margin cost per trade. And 2 is trading offshore. When trading offshore, you have many options of who to trade through. It's important to consider the risks of trading with the brokerage that you choose to trade with. No offshore jurisdiction provides compensation schemes for their clients, and so if the brokerage was to go pop, your funds would not be covered. Offshore jurisdictions include Vanuatu, Seychelles, Mauritius, BVI, among others. Not all offshore jurisdictions are created equal, though. To the top end of the scale, you have Mauritius and BVI, while Vanuatu is considered as a lower quality jurisdiction. So when deciding which offshore broker to trade through, you should consider the legacy of the brokerage. How long have they been trading for? Are they regulated onshore? What's the size of their balance sheet, and can they prove it? With a long track record, the brokerage has shown the ability to stand the test of time, proving that their risk management is strong and they're well placed to sustain any black swan events, such as the dumping of the euro ceiling in January 2015. With onshore regulation, we know that the group of companies has strict capital adequacy and compliance guidelines, segregated client funds, for example, to adhere to. It's fairly typical to see onshore brokers maintaining these criteria in their offshore environments. When trading with a brokerage with a strong balance sheet, you have the peace of mind that the brokerage is well capitalized, and so the likelihood of that brokerage going bust is slim. If the brokerage can further prove the strength of their balance sheet, for example with an investment grade rating, this should give you further peace of mind that the counterparty you're engaging with is bona fide. In any scenario, it's my opinion that the changes in regulation will serve to drive complaints down for onshore regulators, whilst driving clients, traders, and investors offshore. However you look at it, this increases the potential of counterparty risk, as the traders are for the most part trading with unregulated counterparties. When considering your trading options, you should always aim to verify your counterparty's credentials and trade with a well-capitalized, well-established broker. To discuss your trading needs in detail, come and visit me and my colleagues at booth 26, and we look forward to seeing you there. Thanks a lot.